Without further ado, I'd like to introduce Melinda Zabritski. She's the Director of Automotive Finance at Experian Automotive, has some great information to get us started. She's been our kickoff speaker each and every time we've done the Subprime Forum. This is our third year of having the Subprime Forum here at Used Car Week, and Melinda does a wonderful job gathering the data and sharing it in a way that is useful and beneficial to everyone involved. So without further ado, Melinda Zabritski of Experian Automotive.
Well, good morning. So if you've attended the quarterly webinars that we do, don't worry, this is not a repeat of that. So taking a look at really just what is very specific to subprime, and also pulling some different data sources that you haven't seen before. We hear a lot about what's happening in the subprime market, or at least we hear what the media is telling us that's happening in the subprime market. And what we're going to do here is really share the actual numbers of what we see as far as what's occurring in the industry, where we're seeing the growth, and different traits and characteristics about subprime borrowers in the auto space. We're going to cover really four main areas, and as I mentioned, underneath all of this, we're going to focus strictly on what, well, not strictly, but we will be focusing highly on just the subprime portion of the industry. We're going to start looking at just what's on the road, since we talked about this is, Used Car Week, and wanted to overall paint the picture of the volume of vehicles on the road, the types of cars people are buying, and then obviously the huge and tremendous role that financing plays in consumers buying their vehicles. So we'll look at the sales and financing trends. We'll also look at some of the trends occurring in the leasing market, since obviously that's really driving a lot of the late model inventory coming back into the industry. And then finally, we'll look at loan performance. So with the growth in subprime, how is all that translating into how consumers are staying current or perhaps not current on their automotive transactions? So starting off, just what's on the road? The total inventory out there of vehicles on the road is about 255 million cars on the road today. There's been definite growth in the industry. We certainly see that in the numbers. We see SARS forecasting going anywhere from, I've seen 17.4 to 18.1. So certainly huge volume of new cars coming into the marketplace. We took out about 4% of vehicles from a year-over-year standpoint. About 4% went out of the market. Vehicle scrappage no longer being registered. But ultimately, 255 million cars on the road today. So tremendous inventory. Also do want to point out, I should have pointed this out earlier, Q3 data just got finished the last month, just posted overnight. So unfortunately my Q3 data that I'm going to present today is a partial Q3 in some cases, so I'll point that out. But overall, 255 million cars on the road today. And when we look at the model years of what's out there, the majority of vehicles on the road are late model cars. You can see that 72% of what's on the road today is, current up to 14 model years. You certainly see the impact of the recession here with that 2009 model year vehicle. But obviously with sales really rebounding from that, we've built up a tremendous inventory. Of course, a lot of that growth has been spurred by the leasing market, which we'll focus on in a little bit later. But overall, you can really see inventory coming back. The little red stack bars that you see on the slides represent the percentage and the volume of each of those model year vehicles that were basically taken out of operation. You can see the majority of those you really start getting your out of operation in the 1993, 1994 model years is where you get the majority of the scrappage coming from. So I did want to make this a little interactive as well. So I know I can basically go nonstop for hours on this information, and I've been known to do that. But I do want to make this a little interactive, so periodically there's going to be a number on the screen, and it's coming up next. And if anyone can shout out what they think this number represents, 39,326,043. Anyone have an idea? Total car sales. So vehicles registered so far this year through August of 2015. So obviously we talk about the market really rebounding. When we look at how those numbers break down across new and used vehicles, again, market strong recovery since the recession. We see a growth rate here from 2010 to 2015. New vehicle sales through August were about 11.7 million. We've brought in over 27.5 million used vehicles. We're starting to see a little bit of a year-over-year decrease in the growth on new vehicle sales, but used, obviously, well, new vehicle sales, we had those SARS forecasts very, very strong. But overall, tremendous market. And of course, this really speaks to, again, all the vehicles coming back and on the road in operation today. But there's also been a slight change as consumers have come back to the market as far as what consumers are buying. So we started seeing about halfway through last year a shift in vehicle sales. We started to see the entry-level CUV make the #1 slot. When we take a look here again, this goes through August of this year, 12% of vehicles that were registered so far this year were entry-level CUVs. And like I said, that changed about halfway through last year, where all of a sudden you had the economy cars drop down a little bit, full-size pickups drop down a little bit again, but those entry-level CUVs remain in that #1 spot, and that's really also had an impact as we get this vehicle shift. It's had an impact in the amount being financed and the loan amounts, especially on the new car side, obviously, since this is the new car, top 15 new cars. But that's the fact that we've got consumers starting to buy slightly more expensive vehicles, as well as just the cars themselves increasing the cost. You look at the average MSRP, and you've got an increase of about $5,000 in the average MSRP of new cars just in the past 5 or 6 years. So keep that in mind when we start looking at these amount finance, and as these cars again return to market, we're returning slightly more expensive vehicles to the inventory. So also contributing to growth in balances, which we'll look at a moment, has been also a change. As we've shifted what consumers are buying, consumers have shifted how they're buying. And in conjunction, not only how they're buying, but the type of loan products, between loans and leases. But when we look at financing, the biggest trend we've really seen in the last couple of years is consumers increasingly relying upon automotive lenders to make their purchase. You can see back in 2006, so this is Q3, all the way through a full Q3 of 2015, we've gone on the new vehicle side to 79% of new cars with lien holders associated with them, to now almost 87% of new cars having financial liens on them. So a huge shift, and especially on the used vehicle side, just under 51% to now over 55% of used cars have financing. Now, this doesn't mean that consumers are increasing overall debt. What we're really seeing is consumers relying on automotive loans. They're not coming into the market with home equity loans. They're not coming in with credit cards, which does happen. I can always say, yeah, my first used car I bought with a credit card. Of course, it was my dad's credit card, and he wasn't really happy with that, but he took that card away, so let's just, I was a little young. But anyway, so we've got less transactions outside of automotive loans. So again, this also contributes to the sheer volume that we see in balances. But when we look at the used vehicle market, we see a little bit of a different picture. As I mentioned, overall used vehicles, 55% have some sort of financing tied to them. But when we look at late model used vehicles, you can see here your 2012, 13, 14, 15 used model vehicles pretty much look like new cars. And of course, majority of lenders will finance a 2014, 2013 and treat it as a new vehicle. So when you look at the late model used vehicles, you have heavy reliance on lending. When you get down to about a 2005 model year vehicle, it really shifts more into about 50-50 cash. And then obviously when you're getting into the early 1990 model years, they almost all become cash transactions. So $968 billion, $370 million, 11 and 90. Don't forget the $90 here. Ooh, shoot. Might have given you a hint. Any idea what this number represents? Anyone? Total outstanding loan balances. So there are over $968 billion in open automotive loans in the marketplace today. Again, this really being caused by, we saw that shift in what people are financing, relying more on lenders and more expensive vehicles. If you actually look up this number and compare it to some of the worldwide GDP, we're actually right around Turkey, Austria, things like that. So there's more outstanding loan balances than the total GDP of quite a few countries out there, $968 billion. We've had one of the largest year-over-year growth, year-over-year increases in the total outstanding balance, and we continue to hit these record highs. If we continue to have the kind of growth rates that we've seen, which as I've mentioned have been right around 10% year-over-year, we're growing about 3% over a quarterly roll, we'd expect to hit just under $1 trillion at the end of this year, and definitely over $1 trillion mark when we roll into Q1 of next year. So $968 billion in total automotive loans. When we look at the subprime portion, we're really rolling at about $33 billion. Apologize that this really breaks down. I left the legend off. So the number in red is the total deep subprime portion of the automotive market, and the number in blue is the level right above that. So This basically is looking at everything below a credit score of 600, with the deep subprime being that low number. And you can see, so the deep subprime portion, we've rolled up to about 33 billion. We're at about 186 for the subprime portion of the marketplace, which is definite growth, definite increase in balances. But the percentage of loans themselves have remained very low because we have overall growth occurring quite tremendously in the prime and the super prime area. So the total percentage of balances that are falling in these highest risk areas, you can see, are still under about 3.8%, and it's a little bit down from year-over-year figures. So we talk about a lot of this growth in subprime, but it has been a pretty modest growth overall. Obviously, yes, volumes are up, but the entire industry has been booming. So we're not seeing this growth that's just out of control. It's been very stable, very steady. So $4,892,893,825. That's the total loan balances that are 60 days delinquent. So again, we talk about having this growth in subprime, and people are looking for subsequent growth in delinquency. And while the numbers are quite large, we're not, again, seeing a lot of tremendous growth in delinquency. When we take a look at our 60-day delinquency, this chart, I know some of the numbers might be a little hard to see, but we look at two different things from a 60 days. Now, this is 60 to 89. It's not a 60 plus. We look at the percentage of loans themselves that are delinquent, so how many of the automotive loans are delinquent, and that number is about 0.725. Slight decrease from year over year, so a slight decrease in the percentage of loans themselves that are delinquent. Most of the lender types have been pretty stable. You see there's not much change in the percentage of loans that are delinquent year over year. Also, historically, it still remains a pretty low figure. We do have a slight increase in the percentage of balances that are delinquent. Again, mentioned we've got larger balances overall. We have more higher loan amounts, which we'll look at shortly. So overall, we do have a slight increase in the severity. It's up 2 basis points. So 0.64% of the balances are delinquent. So overall, again, we're not seeing anything that is alarming with these slight increases in delinquency. 1 in 3.7. Any idea? Ratio of new cars leaving a dealer's lot as a lease. So huge number, and obviously this is one of the things that we see that's spurring a lot of the high attendance this week at Used Car Week is the sheer volume of vehicles being leased, which is guaranteeing a return in 36 months. So that 36 does remain the most common lease term out there. And when we look at the leasing, obviously again, we've got this shift in how consumers are buying. 27% of all new cars leaving a dealer's lot are leaving so as a lease. And you can see that trend line. You look at pre-recession 2006, 15%. You obviously saw the impact of the recession. Leasing fell down tremendously, but then steadily grew. But we had historically always seen leasing, anywhere between 18 and 20%, and now 27%, and that number keeps on creeping up. What we see in the blue bars are the volume of leases that were done for that quarter. And again, if you go back historically and look at what was leased and what should be coming due, there are 2 million leases coming back into the market or returning back to the market in the next 6 months. Now, I looked at this number about a year and a half ago, and it was a fraction of this volume. So obviously, from the remarketing standpoint, you've got volumes coming back that are just unprecedented, huge volumes of returning vehicles. And when we look at what consumers are leasing, this again speaks to what we see with that shift. So in looking at new car leasing, you've got your typical vehicles, your high volume vehicles do lead the leasing market, your Civics, your Accords, Camrys. But this is also where we started seeing about halfway through last year that push with those entry-level CUV vehicles. So we've got the CRV, the RAV4, the Escape, and the Equinox all being within the top 10 leased vehicles. And they've stayed in the top 10 leased vehicles for the past year and a half. So obviously one of the reasons we're seeing that entry-level CUV remain very dominant in the top 10. Now, when we look at what's coming back to market, so what you can expect to be returning, these are the top 20 models coming back to market. So again, you've got some of the very common vehicles, the very popular, the Accords, the Civics, Altima's usually in the top 10 or right just off the top 10. But you also have some of these vehicles, the luxury brands. You've got a lot of 3 Series coming back. So you have E-Series or the E-Class. So when you look at those brands, obviously the high lines typically rely on leasing. When you look at the high lines, you have very strong penetration of leasing. 70, 80% or more of those brands rely on leasing, but just sheer volume of what you can expect to come back. Now, we also wanted to look a little bit at the used leasing market. Now, used leasing remains a very small part of the industry. We typically see, when we look at the entire lease market, used leasing is about 3.5% of the total lease market. It's not a large part of the industry, but it has been growing. We look at the used, you can see here the used volume. Back in 2008, used leasing represented a much larger piece of the market. Pre-recession, it was 5-6%. Volume is definitely returning, and now in the used vehicle side, you got about 60,000 used leases coming back to market. And when we look at what these used vehicles are, it's a lot of BMWs. You see a lot of BMWs, a lot of Mercedes of what's coming back. So what's interesting is when you look at the used lease market, there's really two complete differences in the market. You've got these top 20, which tend to have higher credit scores. They tend to be more prime consumers. You can see here they're 2012, 2013 3 Series vehicles. A lot of still very late model vehicles that were leased that weren't quite new, but still leased as technically a used vehicle. Then there's the total other side of the used market, which is a very, very subprime player. That represents a much smaller part of used leasing. And those typically are consumers who, quite honestly, don't qualify for even a lot of subprime loans. So you'll have more of the buy here, pay here dealers putting them into something that is almost like a rental type scenario. So again, really two complete different spectrums of what we see in the used lease market. So focusing just on subprime, since that's obviously the main purpose of the next couple days, when we look at the subprime market, we're looking at several things. So we've got the total subprime market. This is everything below a 600 credit score. So subprime market is about 23% of the entire industry for Q3. It's about 26% of the total loan market. You can see represents only about 9% of the lease market. So leasing still remains a very, very prime product, especially on the new lease side. When we look at the new transactions, you can see subprime. It's a very small part of the new car market. New car market is definitely very much focused on prime or higher. You can see on the loan side, it's only about 12% of the loans. It's only about 8% of new leases. On the used vehicle side, it's a little more of an even split. You've got about 34% of the used transactions falling within the subprime market. Now, subprime does really dominate the used lease space. About 46% of used leasing is falling within the subprime space of under 600. So again, when we look at the total industry, volume's definitely up, but especially on the new vehicle side, it's a very small part of the industry. So we're really going to focus a little bit more looking at the used loan side. And when we look at what subprime borrowers are purchasing on the used vehicle side, we can see that this is just the share of each model year that is purchased by a subprime borrower. So we definitely have the subprime market purchasing late model used vehicles, but they definitely represent a smaller piece of the pie. As far as inventory is concerned, it's really subprime really picks up at around a 2005 model year vehicle, which we start moving into about 50% of the 2005 and vehicles really shift more into subprime. And then looking at the early 1990 model year vehicles, it's really a very subprime market. So the subprime market definitely buying across all model years with, again, more of the penetration with those 2000, 2008, 7, and older vehicles. Now, as far as how they're purchasing, when we look at subprime financing, again, mostly subprime borrowers are purchasing used vehicles. When we look at 100% of the subprime borrowers, almost 80% of them are purchasing used vehicles. When they are purchasing used vehicles, it's definitely a loan. So we mentioned earlier, from a market share standpoint, they have a lot of market share of used leases, but it's a very small portion of what subprime borrowers purchase. So again, really across the board, but really focusing on used vehicles. And the most common used vehicles that we see purchasing, again, not just looking at the market share of those particular models, but as far as of what the subprime borrowers want, again, they're really looking for a late model used vehicle. The subprime borrowers really mirror what we see for the overall inventory out there, which certainly makes sense. And about 40% of what subprime borrowers are purchasing is a 2010 model year or later, with 75% of them being 2005. So we get asked a lot, from a subprime standpoint, what vehicles are the most attractive, what should be on lots, what should be sought after from a remarketing standpoint. And again, the classic is typically vehicle 3 to 5 years old, typically a high mileage vehicle is what we see from an inventory standpoint. Now, mentioned earlier, we've got growth in overall portfolio balances. We definitely have a little bit of growth occurring in new vehicle financing. Again, it's a very small part of what's in the marketplace, but the percentage of loans that we see with a credit score of 600 and below, it's up a little bit year over year, but you can see not tremendous growth. We're not quite back to where we were some of those pre-recession figures. 2007, it was over 14.5% of new vehicles were 600 and below. Today, we're just at about 11.5%, but definitely seeing a little bit of growth on the new vehicle side. We can't really say the same on used vehicles. So in the used vehicle market, we're still right around 34% of used vehicles falling 600 and below. It's been very, very stable. One reason from a percentage that we're seeing the volume or the percentage still remain low is, as I mentioned, all of these late model used vehicles coming back into the marketplace is starting to pull more prime consumers into the used vehicle market. So just as an overall percentage, it's really balancing out what we're seeing as far as the percentage that subprime borrowers represent of the used market. So overall, yes, there's volume growth, but there's more growth occurring in the used vehicle space with the prime borrowers. And we see that when we look at the monthly payments and the amount financed, which is starting to make the used market definitely more attractive to the prime borrower as well as consumers right on the edge of prime and subprime. So we mentioned those loan amounts, definitely contributing to the sheer volume in outstanding balances, again, $968 billion. But the average loan amount for a subprime borrower on the new vehicle side is $28,659. You can see a definite increase. We've got over a $4,000 increase since 2008 in that loan amount. And again, the mix has changed. So it's not only higher MSRPs, but we also have consumers, again, buying a slightly more expensive vehicle. On the used vehicle side, the amount has increased to $15,730. So again, not as tremendous of an increase, but definitely seeing that growth in the amounts. And one of the things we started looking at was that gap between new and used financing. So again, we've got consumers starting to shift a little bit from the new market to the used market. As we look at the difference between new and used financing, back in 2008, the gap between a new and used car was about $9,200 for the subprime borrower. Across all risk scores, it was about $7,900. Today's market, that gap between new and used loan amounts for subprime is now over $11,000 and over $10,000 for new. So again, we're starting to see that gap just continue to grow, making those used vehicles more attractive. And again, especially all these late model used vehicles, definitely more attractive. And then, of course, as soon as we've got any bit of a off tick of new vehicle sales, we'll start to see more of the incentives coming down and making that vehicle a bit more affordable. As far as those loan payments, of course, that increase in balances continues to push up the monthly payments. Subprime borrowers on new vehicles are now paying on average $511 a month, up from $474 back in 2008. And the used vehicle side from the subprime borrower is now well entrenched into the 370s. Average payment now $374. So again, that constant increase in those loan amounts, or the loan amounts as well as the payments. We also look at that gap in the payment difference. So from the overall market across all risk tiers, we now have a monthly payment gap between new and used cars of $125 a month, up from $113. On the subprime side, it's also about $20. So not much difference in the shift between what subprime borrowers are purchasing and financing and the difference between new and used, but just definitely overall that marketplace, the new cars are starting to become significantly more expensive, driving up those loan amounts as well as those payments. So 5.3 years, we're going to make this multiple choice. Yay! Y'all get a prize. So yes, 5.3 years. So subprime terms, while we continue to increase the average term, it's not quite keeping up as we saw to those rise in payments. Average subprime loan term is 71 months for a new car. It is 60 months for a used car. When we look at the total market, the overall market, it's 68 for new and 61 for used. So subprime is definitely a little higher terms for new vehicles, but pretty much staying on par with what we see for the overall marketplace. Now, the 72-month term loan certainly has become the new norm. In subprime financing, over 52% of new vehicles are financed at 72 months. Over almost 41% of used vehicles are at 72 months. Now, we've seen a lot of growth in the 73 to 84 term. What we see, however, is definitely a split. So that is a 12-month bucket between 73 and 84. The majority of those loans do fall at 75 credit unions started that program of 72 plus 3. I always just think that's a very long-winded way of saying, 75 months. So we have about 80% or so of the loans that fall within that bucket do fall around 75. But every single quarter and every other year, we're starting to see more of those loans go from 75 to now 78 and creeping up to 84. We definitely see on the new vehicle side, we see subvention occurring at 84 months. Programs we've seen from Chrysler have been at 84 months for 0% for basically all summer. We've seen that. But again, we're starting to see more and more of those loans. People are getting comfortable at 75 and creeping up. Now, it's not a new phenomenon. When we look at those 72 and 84-month loans, they've been around for numerous years. This isn't something that's just a reaction of the recession, but the growth in the 73 to 84 has been something that is some of the highest rates we've seen. There's not much financing above 85, and especially in subprime. There's not a whole lot over 85. On the new vehicle side for the total market, it's just under 1%. But it's creeping up, but still it remains under 1%. And in subprime, you don't see very much at all occurring over 84. Now, one of the things I remember seeing an article, maybe right when the whole subprime bubble was hitting the press, I remember seeing an article of consumers talking about, buying really old cars, not knowing what they were signing, and, a 2003 model year vehicle being put in an 84-month loan. So wanted to kind of debunk some of those cases of one stories that we see. And when we look at, a little bit of an eye chart here, but when we look at the term by model year for subprime borrowers, the red bar is by model year, the percentage of loans done between a 73 and 84-month loan. Notice a trend. You only see that on very late model used cars. So once you get past, 2011, 2012, not a whole lot of financing over that 73-month term. And again, majority of that falls right around a 75-month. Now, certainly most of that financing you see is on the 72-month term loans. Once you get to a slightly older vehicle, though, those longer-term loans really drop off. And you see that blue bar are the loans that are between 49 and 60 months. So there's not this irresponsible lending that some folks would want us to believe, that consumers with old vehicles are being put in loans that they can't afford with very long terms. We just don't see that when we look at it by model year. There's always a few cases, but also it changes when you look at what the cars are. Some of these older vehicles with long-term loans tend to be cars that have very long longevity. They'll be around, and they're certainly going to hold up to those longer terms. So with that, I think I'm actually wrapping up a bit early, so I went kind of fast. So I know a lot of information that we looked at, a lot of numbers. I didn't see anyone keel over, so that's good. Everyone must have had enough coffee to sit through, a good half hour or so of numbers. So again, when we look at what we see with originations, it's definitely a strong market, high volume sales, both on new and used vehicles. We saw the numbers, consumers return to market, and they've returned strongly. We've definitely seen a shift in how consumers are buying. Certainly seeing more leasing, as well as a shift in the kind of vehicles that they're buying, which is having that spillover effect into the loan balances and the overall increase in loan amounts. We don't really see a degradation of consumer credit. Delinquency balances are up a little bit, but overall, again, mentioned, we've got larger loan amounts. The loans themselves are higher, slight increase in severity, but really no more loans themselves becoming delinquent. And again, that's really just all speaking to just a very strong automotive market that we see out there. Again, a little bit of growth in subprime. Volumes definitely up. I'm sure you're all seeing it in your portfolios. Volumes up, but overall volumes are up across all the risk tiers, and not really seeing any extreme growth occurring in subprime that's not out of the norm. So with that, I think we've got definitely a good 10 minutes or so if there's any questions that we've not yet covered.
Excellent job, as always, Melinda. Thank you so much. You shared so much great data talking about terms and total portfolio length. What are you seeing as far as monthly payment thresholds? How much of a metric is that to be watched nowadays? How much buzz in general is that around the monthly commitment that families can or cannot make?
Actually, there's another analyst with our company who's preparing a little bit of a stress test analysis. So we actually hope to have a little bit more of that information to share early next year as far as where we see any payment hierarchy. And if we continue to see these loan amounts continue to increase and those payments increase, the potential is to shift hierarchy. One thing that has resulted since the recession is, the vehicle payments shifted up in hierarchy. People were making their automotive loan payments well before they were making their mortgage payments. You'd always jokingly say you can't drive your house to work, but you can still live in your car, especially those CUVs, which there's more of them, they're bigger. So it's tough to say what that number is going to be. My concern is if we continue to increase those payments, and as the rest of the economy continues to recover and there's more debt that is being taken out, if the potential to increase the delinquencies and the losses. On the upside, you've got, again, this large inventory of used vehicles coming back to market, the whole supply and demand. There's a lot of anticipation about what's going to happen to used car prices, potential prices dropping, spillover effect, making those vehicles more affordable. So that's definitely something that we can hope to look forward to.
Absolutely. Along those same lines, in your presentation, you referenced that being asked about certain models that might fit certain contract terms, portfolio underwriting terms better. What general trends are you seeing in the loan-to-value metric? How is, with the overall expansion of portfolios, how is that metric behaving? How has it behaved over the last 12 to 18 months? Yeah,
so when we look at LTV, there hasn't really been any tremendous increase in LTV. So when we compile this data, it's DMV registration, DMV title based. As we bring it into our database, we also send it over to NADA used car guides, and they append vehicle values to it. So it's not the book value, but it's not not deal jacket value, but it's a good benchmark value. And when we're tracking that, the increases have been very, very modest. We haven't seen an LTV, for example, go from 99 or 100% to now 110%. There's been some slight increases on new, some very, very modest increases on used, but the LTVs are holding pretty stable. I do want to point out, so if you recall, I used to cover LTVs in the quarterly presentations, and I've taken that out. It's still available, but I've taken it out of the quarterly presentations, mostly because it was a little difficult to explain to some of the media sources, some of the more consumer-oriented media sources, kind of what that number meant. So that has come out, but it is still available if people are interested. But I haven't really seen any surprising increases to LTV. Lenders seem to be still holding pretty steady. They might have increased a point or two, but it hasn't been anything that's out of control.
Referencing that consumer media, and I'd like to point out we try our best here to be a business-to-business media property, but you referenced the subprime bubble. Just how much have you been approached to quantify that? Is that starting to be something that's percolating just because the overall outstanding portfolio is approaching that 1 trillion mark, and perhaps that's a buzz catchphrase that might garner some attention.
Yeah, the whole idea of the subprime bubble seems to have calmed down. It really started with New York Times probably 2 or 3 quarters ago. It has been something that's calmed down. I remember sharing some of the information with another reporter, and the response was, well, what's the big deal about all this? I don't see it in the numbers. And I'm like, I know. So it's really seems to have calmed down. There's been a lot of focus on the balances, questioning, is this good, is this bad? And again, we look at the fact that $968 billion, it's not an insignificant number, but when you look at overall consumer credit, overall consumer debt, it's not that growing in conjunction with everything else growing. So like I said, it's the consumers really relying on automotive loans, not bringing home equity, not bringing other types of debt to the table, really using the actual auto loan to make the vehicle purchase, which is what it's there for, obviously. So it's not a growth that's occurring while everything else is growing.
Again, in your presentation, you referenced how much just leasing is intensifying, just how many new vehicles are rolling over the curb as a lease. How much will that become the primary potential collateral that individuals in this crowd will be able to put a contract with 36 months down the road? How much of a quote-unquote safer bet might those vehicles be, reliability-wise, stability-wise for the consumer? How much of a pool of potential collateral is coming down the line for all finance companies, really?
Yeah. Well, as I mentioned, right now in the next 6 months, there's over 2 million vehicles coming off lease. That number is only going to increase as we continue to increase the volumes, increase the percentage. So we're expecting 3 to 4% increases in that number pretty much every single quarter. So a lot of inventory coming back. As far as quality, you look at what those vehicles are that are being leased. It's a pretty solid mix of mid-size economy, some of the CUVs. Obviously you've got leasing tends to have a stronger credit quality of a consumer. On that new vehicle lease, like I said, you don't really see a lot of subprime leasing on the new vehicle side. It makes a great product for the subprime borrower, though, when that vehicle comes off lease. And again, you have a late model vehicle. It's usually very well maintained. But you're also, from a asset quality standpoint, you're also competing with late model used vehicles that are still under warranty and have a lot of service contracts already on them. But a lot of really good quality inventory coming back.
And on the other end of the spectrum, delinquencies, repossessions, how much have they kind of followed the traditional seasonal patterns? How reassuring should that be to the industry that all of a sudden we haven't seen a spike that perhaps was experienced when the most recent recession occurred? Yeah,
from a seasonality standpoint, there's nothing that's been tracking that's out of the norm. We're still following the typical bell curve of delinquency that we see throughout the year. Repossessions, I didn't share it in this presentation, but repossessions have also been pretty stable. Like I said, we're not seeing any big spikes anywhere. Volume's obviously up, but just because inventory is up, but overall as a percentage, it still remains a very low part of the market.
Very good. Well, we are close to the 2016's arrival. Just what are some general metrics or just general trends that you and the rest of the team at Experian are looking to keep tabs on as we hit the new year?
Still, obviously, those total balances. Loan term has been something that's just been fascinating to watch. We'll definitely keep an eye on, again, that mix of vehicles because it has that spillover impact, of course, on bringing those loan amounts up and bringing those monthly payment amounts up. I think everyone's kind of looking at what's that magic point of when will term stop growing. Fortunately, don't really know what that number is going to be, but then, of course, there's that spillover impact of moving into leasing instead. I think we'll continue to see leasing continue to rise, especially when you look at leasing. The average, we look at the top 10 most commonly leased vehicles, and you compare the loan amounts on those vehicles to the lease amount on those vehicles, and it's about a $110 difference per month. So it certainly makes that vehicle much more affordable. On the new vehicle side, though, there's still the subprime borrowers is still a little bit locked out of new leasing. It's very much a prime product, but it's also, for those subprime borrowers who are able to get into the new leasing, it's making that payment significantly more affordable. You also don't see much delinquency in the leasing side. Of course, part of that is because it's a very prime product. So we'll keep an eye still on the leasing volume, definitely the balances, and every single quarter, the first thing I look at is what's happened with delinquency. And like I said, we're just not seeing it grow.
Great. And perhaps difficult to quantify, but just from just the metrics that you've seen, just how great is the subprime consumer pool? How much has it kind of evolved since the recession, since there were, as folks here well know, that the mortgage situation pulled a significant amount of consumers into a subprime bucket out of perhaps no outside of their scale of, or out of their range of potential. But just how would you describe just the general subprime pool? How is it kind of behaved? How might it be going forward?
Yeah, so one of the things that we look at is some of the median credit scores that are within those different bands. And definitely as we moved into the recession, you saw the median credit score in subprime drop. You had more consumers who were just on that non-prime border and dipped back down again into more subprime. Some of the subprime borrowers dipped into that deep subprime category. So you did see that drop in the median credit score. The last several years, the median credit score has actually been increasing bit by bit within those high-risk areas. So we're starting to see a bit of a better quality subprime borrower, if you will. So we're seeing just an improvement in the overall credit quality even within those bands. So we've got consumers who have some of the lower credit scores curing their scores a little bit, those scores starting to tick up. So it's been really some improving credit quality even in the highest risk areas.
Well, excellent. You did a wonderful job
Thank
as
you.
always. Great job with the little metrics there. Just any type of other little data points that the folks in the audience perhaps can take back to their colleagues, or any other little tidbits that would be just a great water cooler piece to share when everyone travels back home.
The only thing I would say is go out and buy a car. You know, it's a good, strong market to buy a car right now. I mean, you see it with rates are still very low. That's what I forgot to put in here with the average rates for subprime. Sorry about that. So, you know, rates continue to be very low. Those terms continue to expand. You know, there's such this great inventory of late model used cars really coming into the marketplace. So, you know, we've really shifted across all risk tiers into a consumer market instead of one that's more, you know, dealer driven. So from a consumer standpoint, we're really owning the industry right now.
Very good. Please join me in a round of applause thanking Melinda Zabritski for the great presentation.